One of the things that has perplexed me all year is that the market, or the smart money, if you will, has been basically calling for rate cuts this year. And if you follow my channel, you know I'm not there. I don't see any cuts this year. But I do want to play with the idea of rate cuts could happen this year, but I don't think people really realize what that means. It's kind of like be careful what you wish for. So I want to talk to Taylor from Life Goal Investment about rate cuts, about how bad things would have to get for rate cuts to happen, because I don't think that is the natural stance. I think the Fed would be unhappy that they are forced to cut. But let's talk about rate cuts. Taylor, how you doing?
I'm doing great. This is such an interesting topic because although I'm not quite as no rate cuts coming this year as you are, right? I think that maybe we get one towards the end of the year. I'm certainly not on three like the market is. And the market's just saying, hey, Jerome Powell, we don't believe a word that's coming out of your mouth because you are telling us that you are not going to, cut rates. I think the quote was something like, in the environment that we expect to happen, a rate cut is unlikely, or something like that. Were almost the exact words out of his mouth. So he's telling us that he's the decision maker and he doesn't anticipate rate cuts coming. And the market's saying, not only do we think you're wrong, but we think you're wrong 3 times.
Yeah, so I think it's fair to say that Jerome Powell is still holding on hope for a soft landing. Let's define a soft landing is below trend growth, but not negative, right? So sub 1%, but not negative. He still clearly sees a strong job market, right? JOLTS report, jobs numbers, it's still strong. An unemployment rate at 3.4%. I mean, hello. So yeah, I think that's where he's at. It's interesting that his staff is not there. It's also interesting if we go back to the dot plot that even the Fed presidents were calling for a recession with 2 quarters. And yeah, I think Jerome Powell is basically saying, I'm going to stick to my guns. You guys were wrong last time and I believed you. I'm not doing it this time. And I think he's in the soft landing camp.
He pounded his chest the other day. He said, we're doing a damn good job. He said, listen, we've got inflation cut in half, essentially, from the 9 handle that we were at in June of 2022. The unemployment rate is still incredibly, incredibly low and resilient.
It's
and
an
then
80-year low or something. It's crazy.
Yeah. And then on the job openings front, he's pounding his chest on the fact that they've been able to collapse that sum, the JOLTS number.
Yeah, about 1 million.
Affecting unemployment.
Exactly.
And, he said, we're also controlling wage growth relatively well right now. And so he said, in his own words, it's more likely that we avoid a recession than enter one. And his staff's words, as you just alluded to, is it's more likely we see a modest recession than we don't. So it's really interesting. But one of the points that you made early on is be careful what you wish for. One of my very good buddies, his name's Jeff Schulze. He's the strategist at ClearBridge, which is a multi-billion dollar, predominantly equity stock shop. He has a recession dashboard that he publishes, and it's widely followed by the financial advisory community. And there are 12 indicators on there, everything from monetary supply to economic things like truck shipments. And every single one of them right now is either flashing. It's like a red light type mentality. Green is good, yellow is okay, red's bad. Almost all of them are red, and I think there's 2 yellows. There are no greens.
Geez. No greens.
So
that's not
it
great.
is going wah, 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 recession coming. And his recession dashboard has been a phenomenal indicator of recessions to come. Interestingly, even though no one foresaw a 2020 recession coming during COVID, his economic indicators had it at moderate. So it wasn't a shock to their system. And it's all data driven. It's all quant driven. And it looks at the leading economic indicators. Now, when you talk about unemployment, what's interesting and what people must realize is that unemployment is the ultimate lagging economic indicator. That is the last thing to show signs of a crack as you enter a recession. Generally, when recessions are entered, unemployment, upon entering the recession, the unemployment rate is the lowest of that cycle. Correct. So to your point, you've made the point that I think we entered a recession at the start of Q2 as a result of a lot of these regional banks. And other people would say, Michael, you're an idiot. Look at unemployment. It can't be a recession with it so low. But again, you enter the recession at the lowest unemployment rate of that cycle. So You certainly could be right. And I tend to think that you are right.
Yeah. Again, this is again, going back to the thesis, let's pretend the market is right and we get 3 rate cuts starting in September.
Yep.
Right.
Yep. Over a 50% chance as of now, the market's saying that we get a rate cut in September.
Yeah. So again, so May, June, July, August. We got basically 4 months, let's call it, before the first rate cut, again, based on the market. Unemployment would have to go up, I don't know, a point and a half at least to
Yep.
kind of get it. And
In
that's
a
just step
very
one. Then you need GDP to be negative, probably a full point. I mean, you got to have some pretty, or you got to have what, 30 banks go under? It's like, be careful what we wish for, guys.
Yeah, no doubt. I mean, the Fed is not going to cut without a catalyst. The catalyst has to be there for an economic backdrop standpoint in order for the Fed to cut. And as of right now, as weak as I think the economy is, and as the trend slows as I think it is, the Fed doesn't necessarily have any catalyst or real. There's nothing that's saying you need to cut rates. You need to cut rates. The market is saying something is going to happen in order for them to cut rates, in order for them to be forced to cut rates. What is that going to be? TBD. But what you just mentioned there is going to have to play out in order for them to do that.
Yeah, again, when we talk about unemployment, right? Unemployment going up 0.1% a month, not enough, right? It's got to be meaningful, I would think. GDP going down, being down less than a point, like -1.5 or less, not it.
Yep.
A bank or two going out every month, not it. An earnings recession, which I think will be confirmed this quarter, not it. There's a lot of bad stuff. In fact, I think it's at least currently more likely that we have stagflation than anything else, right? We have below trend growth and high inflation. It's
Fair.
just
I mean,
kind of in the
where we
soup.
sit. That's where we have been sitting, is in
Yeah.
that stagflationary camp. Yeah. I do tend to think that we will get a continued economic contraction, and I do think we'll end up in a recession. I don't think, because of things I've said on prior videos where there's so much capital on the sidelines, businesses have to be aware that a potential recession is coming because everyone's talking about it. They're prepping their books, etc., and they're preparing their businesses in the best way they can. So I don't think it's that meaningful, nasty downside. But as a function of COVID, like, let's rewind back and explain why this happened again. COVID was a forced economic shutdown. The government said you cannot operate your business any longer. Therefore, we're going to cut a bunch of checks to you and your employees to have them continue to spend money as if they were normal. And therefore, you had this glut of supply, rates got cut to zero, and people went out and spent money. But now they were on the other side of this. We've now experienced this massive inflationary shock as a function of what happened during COVID, and rates got yanked higher at a precipitous rate faster than they have in 40 years. What happens because of that? The economic cycle stops and resets. And that's what I expect.
Yeah, so I don't see rate cuts this year. You do see one. So what do you think the catalyst will be? Is it negative GDP growth? Is it high unemployment? Is it bank failures? Is it a combination of all three? What do you think the catalyst is for a December rate cut?
The banking issue is real. The banking issue is very real. And therefore, I think as a function of that, that bleeds through into a more systematic slowdown of the economy than we were already experiencing. Banks have to look at their balance sheets right now and say, one, we know we're losing deposits. So if we sit on, let's use numbers here, if we generally sit on 10% liquidity, we know that 10% is being withdrawn. We need to build liquidity elsewhere. Where does other liquidity come from? A lack of lending. So if they stop lending to build their liquidity in order to meet withdrawals when they come, which they know are coming, and if that gets exacerbated, they have to stop their lending program even more quickly. And that just is sand in the gears of the economy and slowing it down. And so I think that the catalyst for a more pronounced economic slowdown is the regional banks. Again, there are so many of them. They lend to small and mid-sized businesses, which are the underpinning of our economy as a whole and employ half of our workforce.
Yeah, no, I think you're right. I think that's where I go to. Is I don't think enough people are looking at just the sand in the gears, if you will. And I think today it's one of those economic reports that doesn't come out pre-market. I think it comes out at 11 Pacific, 2 Eastern. I think it's called the Senior Loan Officers Survey. I think that comes out today. That's going to be pretty eye-opening.
Yeah, that was what there's an acronym for it, or there's something they call it the SLU report or something. Whatever. Powell was talking about it last week, and he was saying that we'll see the banking activity based upon that. And to your point, we should be looking at that. But yeah, I just think that when banks slow down, again, it just money supply dries up, And
and you know what's happening in the banks that no one's talking about? And I was at an event this weekend or last weekend, I guess, that validated it for me. I believed it going in based on personal experience, but now it's nationally been validated. There are operators of commercial properties who have never missed a payment, who are in good financial health, that are actually not going to be able to refi. Their terms are coming up. The asset's fine. The operator's fine, but the regional bank needs cash. Back to your point, you had 10%, you had 10%. Where are you going to get the money? It's not only, Taylor, less lending. It's I don't know what it's called, forcing a refi somewhere else or a sale with the active loans you have today. Nobody is talking about that. There are going to be good loans that are forced to close or whatever that's called. That nobody is talking about that. That is going to be a giant. You're going to be an operator like me. I own office buildings. I have to fill out a personal financial statement every year for my commercial loans. I went to one of these about 6 months ago, and he basically said, Michael, you're good. Your LTV is below 50%. You have money at our bank. You're fine. But he said, hey, can I talk to you? I said, of course. He goes, you see that folder on my desk over there? I can't refi 50% of our loans.
Ouch. Ouch, ouch, ouch. You're right. No one is talking about this. A lot of people are talking about, and I'll let you keep going, about the broader commercial real estate problem, which we could talk about. But no, I have not heard this come up anywhere.
This is huge. Nobody, I mean, again, you're a regional bank. You need cash. Deposits aren't coming in. In fact, they're leaving.
Correct.
You're going to look at your loan book, and even if you know the operator, even if this, even if that, you're going to say, sorry, I need my money.
Yep. And even more holistically, and Warren Buffett and Charlie Munger talk about this weekend in Omaha. They talked about the fact that commercial real estate at a broad landscape standpoint, they talked about offices, they talked about malls, and a couple other areas of commercial real estate that are just really having struggles right now. Occupancy in New York City right now for office space just hit its high water mark of, I guess, non-occupancy, I should say, of 16%. That's the highest it's ever been.
San Francisco, 32%, not 32%. Occupied.
There you go. So you think about that, that person needs to have, demand for that space to then in turn pay their loan on the other end. But the other thing about the loan on the other end is that different than mortgages, which are almost exclusively fixed rate these days, these are variable rate.
Yep, variable rate.
Variable rate. So every 5 years or whatever, they reset higher. I just had this happen. I own some commercial real estate in the town that I live in, and our rate went from 3.75 to 5.45. And if you're getting that huge cash, chop of the legs from underneath you, and then you couple that with the struggle to find a tenant, it's like the cracks are out there for commercial real estate as well, which is, again, a huge part of the book of business of these regional banks.
Yeah, but let's take your example, right? So let's just pretend your regional bank goes, Taylor, sorry, buddy. You're a great loan. We love you, blah, blah, blah. Thank you for your deposits, but I can't refi the loan. I need the cash.
Yep.
You as an operator you only have two choices. You go somewhere else if somebody doesn't know you. You could do a cash in refi to bring the loan down because maybe that gets it done, or you're forced to sell.
Yep. Yeah. And that would be a real predicament. To your point, all of a sudden you're getting forced to purge things onto the market. The commercial real estate prices come down across the board, and all of those commercial real estate properties that people own that are still on the books of the mortgage companies and the regional banks take it on the chin from that perspective. Yeah, it's a domino effect that I hope we don't experience to the severity that could happen.
Taylor, where can people find you?
Yeah, find us on Instagram and on TikTok. We put out daily videos there. We're at Life Goal Investments.
Thank you, buddy.